Hello, and welcome to our webcast. I'm Stephanie Asa with Moss Adams, and I'm going to get us started for today's session, 2025 Trends in the Fuel Distribution Industry. We're pleased that you joined today. And now I'm going to play a brief video that will go over how to interact with your console.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And without further ado, I would like to hand it over to Jeremy McInturf, Senior Manager here at Moss Adams, to get us started.
Thank you, Stephanie. So good morning or afternoon, depending on where you're joining us from. I know we'll have some people either tuning in or watching this later from the East Coast. So happy to have you all here. Thank you for joining our fuel distribution webcast on industry trends. As Stephanie said, my name is Jeremy McInturf. I'm the sector leader for the fuel distribution group here at Moss Adams. So with us being fresh off the Western Petroleum Marketers Association Expo, this group here thought it'd be prudent that we put this webcast together and really give an inside look on the perspective that we see in this industry as CPAs who focus almost exclusively in this space. So at Moss Adams, we've been committed to the fuel distribution space for quite some time now. Many of you have seen us in the market at industry events or doing speaking roles or know the clients that we serve. So you know us and our backgrounds, but just a little bit about me as the sector leader. I've spent my 15+ year career here at Moss Adams working in the fuel distribution industry, as have many of my colleagues that we've brought on to present today. So we spend the bulk of our time serving clients in this space. So we have a wealth of industry knowledge, and we're really looking forward to sharing that with you today. Before I hand the mic off here, just a little bit about the fuel distribution practice here at Moss Adams. You can see a firm overview that's being shared on the screen with you right now. The firm has been in existence for over 100 years. We have over $1 billion worth of revenue here at the firm, 30 office locations, really concentrated on the West Coast, but continue to move east. Even new offices popping up every few years. So, and then also our expertise in the actual transportation and logistics space, which is where our fuel distribution sector falls within. So we have over 300 clients, 340 retailers and convenience stores. Our expertise runs really deep in this space because we've been serving clients in this space for such a long time. As you can see to the right here, broad industry expertise. And I think even the next slide touches on this a little bit, but our fuel distribution space really focuses on everything downstream from the extraction and refining process, everything to do with moving the fuel all the way down to the C-store level. We have clients that are terminal operators, they have pipeline activities, bulk oil and lubricants, card lock, C-stores, e-commerce, retail environments. I mean, you name it, everything downstream to where the fuel actually reaches the consumer. We deal with clients in this space on a day-to-day basis. And our expertise, specifically as it relates to accounting and finance and other consulting services, also runs deep, especially here in California, but also in other states throughout the country. No one knows better the regulatory environment. A lot of our clients are dealing with things like cap and trade, the greenhouse gas emissions, how do we deal with compliance there? You may also be dealing with other accounting things that we see on a day-to-day basis. So a lot of industry expertise, and we're happy to share that with you today. You can see here too on the second slide that we have various degrees of industry solutions that we're used to providing to our clients and discussing with prospects. Obviously you have your core services like the audits, the reviews, the compilations, the tax returns, but it goes much deeper. We deal with wealth management, tax reform, transaction planning. A lot of those things we're going to be discussing today. Enterprise systems, valuations, due diligence, tax credits, inventory tax planning, cost studies. You name it, we can do it all. We're a full service CPA firm. So without further ado, we have a star-studded cast today, and I'm happy to pass the mic on to Ken Wittwer, who is a tax partner out of our Fresno office, to take our first topic home. Ken?
Thank you, Jeremy. Welcome, everyone. Glad you could join us this morning or this afternoon. I'm going to cover a few topics on the tax side of things, and the first topic is the outlook for 2025 and the Tax Cuts and Jobs Act's provisions that will be expiring this year. The TCJA, as it was known or is known, came into existence during President Trump's first term in office, which was in 2017. And this enactment covers the period of time from January 1st of 2018 through December 31st of this year, 2025. At the end of 25, there's several provisions that basically revert back to how things were in 2017. So we get to put on or go into the Wayback Machine and hopefully remember how life was before the current regime, or excuse me, the current law stands today. So a few of the things that will be reverting back, individual tax rates will go back up on the marginal side to 39.6%. Currently, they're at 37%. And again, this all takes effect 1/1/2026. The standard deduction was doubled for within TCJA, and it will then go back to what it used to be, half of that amount. The child tax credit is currently $2,000, and it will go back to $1,000. On the estate tax side, which is not covered on the slide, but on the estate tax side, the exemption stands at $13.99 million in 2025. At the end of this year, it will go back to, we think, somewhere around $6.5 million, depending upon inflation. Back when this back in 2017, that amount was about $5.5 million. So losing quite a bit of estate tax exemption through this process. Some of the more important things on the business side of the ledger, the corporate tax rate was actually a permanent change, and it will stay at 21%. It will not go back up. The pass-through deduction, which the TCJA changed the ability to deduct 100% of your state and local income taxes, and put a cap on that of $10,000. And if the TCJA does not get approved again, then the SALT deduction, state and local tax deduction, will be unlimited again. And there's some nuances to that, which I'll cover in kind of the next section here. The 20% QBI deduction would go away at the end of this year, and that's the qualified business income deduction that businesses are able to take on pass-through entities. And bonus depreciation, which is a real important one. So bonus depreciation is currently in a phase-out stage, and in 2024, bonus depreciation was limited to 60%. So in the past, it was 100% bonus depreciation, meaning all your capital expenditures for items that had depreciable lives of 15 years or less. 100% of that amount was deductible, and it is now being phased out. As I said, 60% in 2024. In 2025, it'll be 40%. In 2026, it'll be 20. And in 2027, it will go down to zero. I think some of the other items with regard to credits, so the research and development credit, there were some changes there where the credit was not exactly eliminated. However, a lot of your research and development costs now are capitalized and amortized over a period of time. So that credit was essentially lost. So what kind of impact does this have on your industry, on your businesses? Well, obviously, if tax rates go back up, folks will have less discretionary money to spend. There'll be some increase in operational costs from your perspectives. Technology and innovation, you'll have less dollars to invest if tax rates go up, and there's additional regulatory compliance associated with making changes to tax laws and how you're reporting activity on your entity's tax returns. The next topic is the California state and local tax workaround. And this again was part of a way to get around the state and local tax limitation on the $10,000 per year. And many states, including California, developed this program, this law. And essentially what it does is it allows a business, pass-through entity, an S corporation, an LLC, or limited partnership, allows them to make a payment at the entity level on behalf of the owners. And this payment covers the state tax, California state tax, that the entity would essentially pass through to the owner. And once the entity makes that tax payment, it becomes a reduction in the federal taxable income from the pass-through entity. And that payment is then allocated to the owners of the companies and treated essentially as an estimated tax payment. So they would get a credit on their income tax returns for the amount of pass-through tax that the entity paid on their behalf. If TCJA expires and the SALT cap limitation goes away, essentially there's no need for the SALT tax workaround. Having said that, Governor Newsom has come out over the last few weeks and said that he would like to extend the pass-through entity tax regime if the state and local tax deduction continues to be limited. So there's some good news there from the governor in that he's willing to extend this program and basically allow taxpayers a benefit for paying their state income taxes. From the state's perspective, it doesn't really matter one way or the other. State taxes are not deductible on the state side, so whether it's through this pass-through entity or the unlimited SALT deduction, the state of California really doesn't care. They still get their money. Next topic is the beneficial ownership reporting. This has caused quite a bit of confusion and angst amongst business owners and businesses. Essentially, the FinCEN came out and was going to require business owners to provide reporting on ownership interests of their entities, basically a federal registry so that the government could potentially track and match up ownership, entities, tax reporting, et cetera. So there was a lot of pushback, and A couple of weeks ago, Treasury came out and said that they're going to suspend enforcement. So there's no, at this point in time, there's no reporting requirements under the BOI. There's been some rumors that they will continue the program, but only for international or companies that have international activity, companies and owners that have international activity. But at this point in time, everything's suspended. And so that's, take that one off the list of things we have to worry about. Finally, annually, the IRS puts out a list. They call it the Dirty Dozen. This year, it's not as sexy as it has been in the past. Most of these this year on the list are common sense, the phishing and the the email scams and those types of things. But there are a couple that are worth pointing out, and one of those is the false fuel tax credit claims. The last couple of years, there's been quite a few firms out there that are promoting taking a fuel tax credit and basically, really pushing the envelope on what is allowable for that fuel tax credit. So the IRS has cracked down on that. The employee retention credit is still a hot topic with the IRS. I have seen a few clients that have started receiving checks. They're getting their checks on their ERC claims. So it looks like the IRS has finally cleared out the queue on auditing, looking at all those claims, but they still have an eye out for that. Let's see. Finally, there's been a big push. You'll see some, or maybe heard rumors of quite a few folks reaching out and under the offer and compromise regime that the IRS has. So if you owe tax and you want to make a claim and try to negotiate that tax, that's a legitimate thing to do. However, there's quite a few firms out there that are pushing these offers and compromise as a way to claw back some money for their clients. Thank you all for joining us, and appreciate the time. And I will now pass it off to our next presenter.
Thanks, Ken. Hi, everyone. My name's Ryan Dover. I'm a director in the Moss Adams transaction services practice. So I specialize in merger and acquisition, buy, sell, financial due diligence. What I'm going to be talking about today is kind of general M&A activity trends and the 2025 outlook, and then focus more specifically on the fuel distribution and convenience retail space, and then finish out with discussions about the due diligence process and key areas of focus. So I guess without further ado, 2024, it was a challenging year for M&A. While M&A activity did increase in 2024 after hitting a low point in 2023, deal volume was lower than expected, with private equity delaying exits. This was largely due to challenging regulatory environment, elevated interest rate levels, and general economic uncertainty. Now, the Trump administration has moved quickly to roll back Biden-era policies and is anticipated to introduce more relaxed antitrust and merger guidelines, which could help create a surge in deals. This shift comes after a challenging period where regulatory scrutiny has hindered larger transactions. As companies gain more predictable outcomes and timelines, we would expect a more robust increase in M&A activity. What remains to be seen is how the Trump administration's tariff and immigration policies are going to impact the M&A market overall. We're beginning to see financial sponsors reemerging following the election. Elevated interest rates throughout the better part of the past 3 years have had a negative impact on M&A activity. These higher interest rates have led to increased borrowing costs and lower corporate valuations, which has really been the cause of financial sponsors delaying these exits. As a result, we're now seeing pent-up supply in the industry, with about half of PE-owned portfolio companies being more than 5 years old, and close to 30% being 7 years or older age. So, additionally, private equity and venture capital firms are currently holding about $2.6 trillion in uncommitted capital, This uncommitted capital, coupled with an aging portfolio of PE-owned assets, is creating a pressing need for financial sponsors to monetize these investments. Although uncertain, there is hope of decreasing interest rates as inflation begins to return to normal, and hope of the Trump administration passing tax regulations that would benefit M&A. These items would have the benefit of reducing cost of capital and tax burden, and driving up valuations, making an M&A transaction more attractive to both buyers and sellers. So as these financial sponsors begin to sell their assets, we would anticipate a wave of activity in the M&A market. Excuse me. Moreover, with a more favorable regulatory climate and the potential for reduced borrowing costs and tax burden, companies are also poised to deploy these capital, their capital more aggressively. We anticipate an uptick in strategic deals across various sectors, and including cross-border deals, as the U.S. economy has outperformed its foreign counterparts. The foreign companies, they're likely to seek acquisitions in the U.S., or conversely, U.S. companies may look to acquire foreign firms to capitalize on lower valuations and use the opportunity to expand their global footprint. But again, it remains to be seen how the Trump administration's tariff policies will ultimately impact cross-border M&A deals. All in all, though, the M&A market, the landscape for 2025 is looking promising. Next slide, please. So consistent with overall market, there was a notable decline in merger and acquisition activity within the fuel distribution convenience retailing sector for 2024. The industry saw a 29% drop in transaction volume compared to 2023, and an 18% drop from the 10-year average over the past 10 years. So this downturn can be attributable to several factors. This includes uncertainty surrounding the 2024 election. I think that was kind of one of the primary drivers as of late, which created a cautious atmosphere among potential buyers and sellers. And as previously noted, elevated interest rates also put pressure on valuations in the fuel distribution and convenience retail space, resulting in a disconnect between seller expectations and buyer valuation metrics. Since the election, market sentiment has improved, with participants feeling optimistic about the future of the industry and the M&A environment. Transaction activity is expected to increase in 2025, with valuation multiples remaining consistently strong, as it has been over the past 3 or so years. Based on publicly available data, the average purchase price multiples were 10.3 times enterprise value to EBITDA for the years from 2018 to 2020. And from 2021 through 2024, sector participants have drawn average purchase price multiples of approximately 12.3x enterprise value to EBITDA. So average purchase multiples have gone up over the past few years, and especially in participants that had strong in-store programs that were offering high margin products such as alcohol, grocery items, fresh foods, etc. Inflation and consumer behavior and spending patterns have had an impact on fuel sales volumes, though. The average age of the fleet of U.S. cars and light-duty trucks is currently at an all-time high. And as older vehicles begin to be replaced with newer, more efficient internal combustion vehicles, fuel volumes are anticipated to decline. Additionally, younger generations are increasingly prioritizing sustainability when making car buying decisions. As EVs begin to make up a larger share of the market, it's anticipated that fuel volumes will continue to be negatively impacted. National average gasoline fuel margins for 2024 were the second highest on record at 39.7 cents per gallon, up slightly from 2023's average of 39.4 cents per gallon, which was just below the 2022 record of 42.9 cents per gallon. So while margins do vary by geography and retailer, it's become widely accepted that the margins retailers have experienced over the last few years are going to be considered to be the new normal. It's kind of what it is. Fuel margins are expected to continue to increase consistently with historical trends, as the increased margins are needed to offset inflationary operating expenses and reducing fuel volumes, especially as inside sales and gross profits are not keeping pace for many operators. Declines in fuel volume and tobacco sales, coupled with rising operating expenses, payroll costs, and general service costs, continue to increase the break-even fuel margins for lower performing operators. More sophisticated operators, however, are they're going to continue to see bottom line benefit from higher margins, and this is all going to result in higher enterprise value. Despite a decline in transaction volume, though, the appetite for high quality assets remains high. While the number of deals has decreased, competitive offers with strong valuation multiples have persisted for premium assets. This indicates that while the market may be experiencing a slowdown, there is still significant interest in acquiring well-positioned companies. And as we look ahead to 2025, the outlook for M&A activity in the fuel distribution, convenience, retail space does appear promising. The strong demand for acquisitions of buyers with healthy balance sheets and the strategic advantage that comes from consolidation. Companies are increasingly recognizing the value of scale and the efficiencies that can be achieved through strategic acquisitions. Next slide, please. And as deal sizes start to get larger, as can be the case in the fuel distribution, convenience, retail space, the due diligence process can get much more robust, especially when outside third parties like capital partners, lenders, reps, warranty insurers are involved. They have a fiduciary responsibility to do their own due diligence, and their areas of focus and level of comfort can vary greatly. So a full suite of due diligence is not only beneficial for you, but can generally be a necessity for large or more complex transactions with multiple outside partners. The primary purpose of due diligence is to provide a comprehensive understanding of the target company's financial health, operational capabilities, and kind of suss out any potential risks or exposures. A thorough analysis of the financials of a target can help to confirm cash flow, enterprise value, and it can provide insight for post-transaction strategic planning purposes, or could help to uncover or identify any hidden potential liabilities or exposures. While all due diligence has its purpose and can provide value, my specific area of focus is on the financial due diligence side, as I mentioned. When we're evaluating a target, some of our key areas of focus are looking at fuel sales and gallon sales, doing price volume analysis, and looking at margin and looking at that separate from convenience sales and its margin. Important to understand the two key aspects of the retail fuel sales versus the convenience retail sales. Looking at EBITDA or possibly EBITDAR, so that's also adding back rent expense at a four-wall location or store level. So what that's telling us is what does the performance of each standalone store look like if they were operating on their own without excess administrative overhead burdening their profitability and bringing down the value. We analyze and quantify potential impact of changes in incentives due to benefit of having greater economies of scale than maybe the target currently has, or even as a result of rebranding. Something else that's pretty important for us is analyzing, quantifying the potential impact of closed locations or the potential benefit of closing unprofitable locations. And on the flip side, analyzing, quantifying the potential impact of, what would a store look like, a mature performance store look like if it were currently under construction or maybe newly opened and still in the process of ramping up operations. What sort of impact would that have on future profitability and value, enterprise value of the company? So just a couple key areas that we look at, but it's a full analysis, detailed analysis, looking at everything from accounting policies, performing validation, et cetera. So I know I went a little long here, but I really appreciate it, and I want to pass it off to Kris to go through.
Thanks, Ryan. Kris Dunning, I'm a partner in our San Francisco Bay Area practice. I involved in our retail practice, also run our grocery practice. I can go through these pretty quickly here. You can kind of read through the slides. I'm just going to touch on a couple highlights that I'm seeing in the sector. And AI is impacting things. I think one of the companies that's investing significantly in this that will impact a lot of our clients is Circle K, they've invested a lot in both the customer side and the employee side. So just an example of what they're doing in that space is on the customer side, they're using a lot of QR codes to let customers interact and give real-time feedback or cleanliness, other issues in the store. On the employee side, all the employees have an app that resides on their own, so they're able to force that immediately to the store level where they can make on-the-fly changes. They can basically, the corporate side is confirming these things through pictures, through the apps and other things that they have. So there is a lot of space here for improved operations, both, we've got a few examples. We've got, predictive maintenance, supply chain. You can use third-party data to basically help you predict levels both at the gas level and also, I'd say, down to the SKU level within the store. Customer relationship, I would say if your loyalty program is really just focused on purchase discounts on fuel, you're really thinking of how can you personalize that more to make it more meaningful to the customer, get them off the island into the store. When it comes to data analysis things, there are companies out there that can help you analyze what can different store layouts look like, and they can do that virtually with interacting customers going through there to kind of help you with that. But if you've got questions on the retail side of things, we're more than happy to help you with that. You can shoot any of our team members some questions. We'd be happy to reach out to you and get back to you. So sorry we ran out of time here at the end. I appreciate everyone that's stayed on till the very end here. I'll turn it over to Stephanie to just wrap us up real quick.
Thank you so much to our presenters and to our attendees for attending today. If you want to get a hold of any of our presenters, their contact information is on your console and on this last slide. And if you have a moment to fill out our survey, that would be great. Otherwise, have a wonderful day, and thank you for joining us today.
Thanks, guys. Take care.
Thanks, everyone.